Hi there, Jeff Campy here. So in this video, we're going to be talking about some of the key advantages of how you can best utilize a whole life policy versus a private banking policy. So I'm going to do a screen share here real quick, and we're going to jump into what we're going to talk about today. So we've had a client that this video is going to be designed for, and we're going to use this as just a training video for anybody that has this type of a dynamic going on in the future, and how to get the most from your life insurance policy, whether that is the traditional way of doing it or the way that we do it, where we're utilizing it more for wealth creation and a very superior way of utilizing this financial tool, which is a very good financial tool, but in the traditional sense has some limitations, and in our way of doing it has some superior benefits to it. So let's jump into some of the ideas around how you should be thinking about this type of a discussion. So when we think about money, putting money away, building wealth, utilizing money in this case for children or grandchildren and their future, and we think about a lot of times at the middle class, we're trained to compile and accumulate and put away a big pile of money. And that big amount of money is going to give us the security that we want in retirement and really lead to where we want to get to. Now, there's other schools of thought, I find them to be superior schools of thought, where cash flow is really the king. It's the lifeblood of your life, of your business, that if there's not the cash coming in, if the money that you are putting in some sort of a financial vehicle to grow isn't producing income for you on a regular basis, you're really missing out on the potential of that money. Just having a large sum of money there doesn't necessarily do a whole lot for you. It can provide some security and obviously can provide, like income streams in retirement and that kind of thing. But you also have to be careful there when you analyze the numbers. I've recently been doing this. When you think about having maybe $1 million in some sort of a retirement vehicle or an investment vehicle, when you look at the ups and the downs of the market and how those things play out, if you want to make sure you're going to have enough retirement money to live on, you need to be taking 3% or less per year to have a 95% chance of making it all the way through retirement. If you just try to take up to 8% per year withdrawals out of $1 million account, you'll have about a 5 to 10% chance of having that money make it all the way through retirement. Now, that doesn't sound like abundance to me. That doesn't sound like quite the thing I would want to participate in. So that's why we're looking to alternative vehicles. And you're obviously already on the right track by talking about this with us, or even having things in place with us and wanting to be more educated on what are the pros and cons. So for us, cash flow is superior to accumulation. We want whatever money you've accumulated to be producing cash flow and not just sitting there dormant for you or underperforming when you do decide to take money from it. Now, I know this discussion is centered around children and grandchildren and thinking about putting money to work for them on their behalf, which is a huge blessing. Congratulations on doing something like that. It's a powerful thing that you're doing for them. And it's just a great way to help them start on the right foot financially, because so many people get caught in the trap of the middle class way of doing things, where we are consumed by debt, we're trading time for our money, we're barely making ends meet, we're caught on the financial hamster wheel. And good for you to be able to help your children and grandchildren get out from that and have hopefully a better life if they continue to utilize these principles and put them in place once they're an adult. So I want to start this discussion by thinking long term, even though we're just thinking about starting, in our children's or grandchildren's life, putting something like this in place. But the discussion is really about their entire life and how is it going to benefit them for their entirety of their life, not just up front, not just in the middle years, but in retirement all the way till they're no longer here. We want to be making sure that the money we're putting into this type of a policy is doing the best things for them and utilizing that money to the best of its ability for the things that are needed at the different phases of life. So we're going to go through a little bit in this video. We're going to talk a little bit about some of just the key concepts. I'm going to bring up the illustrations of two clients right now, or actually with one client, but it's two different illustrations talking about the whole life policy and then the private banking policy. We're going to compare and contrast some of the numbers and give you some key things to kind of put through your mind and make sure you're making the right decisions for what you want to do with the money you're going to put to work for them on their behalf. So when we're talking about making the most of our money for our heirs, we want to be looking at really the two things that are possible when you talk about life insurance. There's a traditional way of doing it, and then there's the private banking way of doing it. Now, in the traditional sense, you go to most life insurance agents and you talk about how you can utilize that. When they structure that policy, there's going to be a very high death benefit up front, which in my opinion is not as needed. That if you're doing this for children and grandchildren, statistically, they're not going to need a death benefit. Hopefully they don't need a death benefit. And putting the money to work more on the cash value side is where you're going to be putting that money to best work for them instead of putting it on the death benefit side. Now, there still is cash value in a traditional whole life. It's still growing at a guaranteed rate. It's still good. There's still cash going on, and we'll show you how these numbers play out. Now, traditionally, though, in this belief system and philosophy of utilizing a whole life policy, you're actually withdrawing the cash value, maybe as they become a teenager or once they become an adult and want to buy their first car or go to college. You can do that with a withdrawal of the cash value. And that is going to have some limitations we'll talk about. Now, from what we're structuring in a whole life policy with the private banking, we're using some advanced methods that a lot of agents are not trained in, and how to structure these types of policies to be the best performing now and overall for their future. So for us, when we're putting one together, there's more cash value up front, through the middle years, at the very end, the entirety of the entire contract with the life insurance company, there's more cash available, which is important because you can put that money to work. Now, that money is still growing in our type of policy while you're utilizing it. Now, in a traditional whole life policy, generally speaking, if you were to withdraw that money, the amount of growth inside that policy is going to be calculated on the net, not the principal put in there. So let's give you an example. Let's say we have $100,000 in a whole life insurance policy, and we withdraw 50 of that to go to college. The growth inside that policy is only going to be calculated on the remaining 50,000, not on the entire 100,000. The way we do them, when we structure them the way we do, the cash value that's growing in there, you're going to have more cash value. So you'll probably have more than 100,000. You might have 115 or 120,000, depending on how the numbers shake out, to utilize. And let's say you take that same 50,000, but you're not withdrawing it, you're taking a loan against it, which is the key difference. That money is still growing inside the policy as if all 120,000 was still there. So you're getting the growth on 120, not 50, as in the traditional whole life policy. But then you're still able to utilize that money and put it to work for you, like I mentioned, to pay off, college, or buy a first car, buy a first home. Maybe they're an entrepreneur doing trade school, or who knows what they're doing and putting that money to work for. But that is the power of it and how ours are superior. So you're basically being able to do two things simultaneously just on the cash value part of it, where you're getting the compounded growth, just like you are in a traditional whole life policy. You're getting guaranteed, uninterrupted compounding growth, which means there's no dips in the market. They're going to affect your compounding. You're always growing. You're always gaining in a tax-free environment. But while it's growing, you're able to utilize that money like the banks do. So, banks don't park money and let it sit and grow for 40 years. They're moving money, something called the velocity of money, where they get our money that we deposit to them, and then they loan that out to multiple people over multiple years, probably multiple times, and they're getting principal and interest off that loan. And so that's how they make money. Now, most banks are making thousands of percents profit each year off of our money that we're willingly depositing to them, but we don't know how they're making money. We think that they're just making 3% on this loan and 7% on this loan. But when you understand how all the money goes together and the volume of interest and how the velocity of money is actually making them thousands of percents of money and profits by utilizing that. And this is a principle you can put to work in your life, in your family, in your business, and start putting money into your own type of private bank. And I have videos that go into this further, but then you're able to take a loan or essentially a line of credit against the cash value of your policy. The insurance carrier sees that cash value as collateral, and they'll give you a loan on that. And that is like setting up a line of credit that you can then start using in what we call recapturing money that's normally flowing out of your hands. So that's a powerful thing in a differentiation between a traditional whole life policy and the way that they're traditionally used and taught to be used, and what we're offering here with the private banking policy. So let's jump into some numbers. I'm not going to go through this in exhaustive list. I'm going to highlight some areas. We're going to talk about some key points in time and how they stack up comparatively. At the very end, we're going to have a chart that shows you exactly how these numbers play out and give you real easy to you in black and white how they compare, and show you how the private banking is the superior way of putting your money to work on the behalf of your children or grandchildren. In this case, what we're talking about here in this video. So we're going to talk about these few columns here. Here's the orange column. This is just the amount of money you're putting into this, putting to work for your children or grandchildren on their behalf. There's the guaranteed side. This is the cash value. And this is the non-guaranteed cash value. Now, the difference is there's dividends that are paid out. The dividends are not guaranteed. The company that this illustration is with has paid out dividends 140 some straight years. So it's the next best thing to a guarantee. So there's a slight difference between this green column here and this green column here. But we're going to be mainly talking about the second green column. We're also going to touch about the death benefit here in blue. So let's just point out a few moments in time here at different intervals. This is a traditional whole life policy. This is the way that your typical whole life insurance agent is going to write this up for you. And we're going to show you a little bit about how this works. So in year one, we've put in this case, this client in this illustration, there's some extra money going in year one because there's an existing whole life policy that's a traditional one, and we're going to convert that over to our private banking one, most likely, if that's what he chooses. And that is going to be a little bit more money going in the front end. And that's actually going to add to the cash value in year one. Typically, if there was not this extra amount, there would not be any cash value available for the first 2 to 5 years, depending on how all the numbers shake out in the different scenarios. So in this instance, there's already almost $3,000 of cash value as a starting point and $210,000 worth of death benefit. Now, as these numbers go down, I'm not going to compare every line. We are going to go down here to this bolded box here, and this is at the client's age of 18, where more than likely they would take ownership of this policy and start contributing it on their own and utilizing this as an adult. And we want to look at where this stacks up at this point. So there's been, we look at the amount of money that's gone into this. This is the 13th year of the policy. So there's been 12 years of 1,200, which is a little over $14,000 plus another 4,000. So we're talking about what, $18,500 that have gone into this. And in this traditional whole life policy, the amount of cash available is less than what we've put in. There's a longer period of time in a traditional whole life where the money that it takes to fund it is you've basically broken even. You're at a net gain. And the reason for that is because more money is purchasing death benefit and not going to cash value. And that's the significant thing. We're going to point out the difference when we get to our banking policy and the difference there and how it's more advantageous. You're putting the money to work for you in a better way than in this traditional sense. So 21 is also a potential time where they would take over the control of this policy and start contributing to it. And obviously they'd want to continue to contribute to it just for the standpoint of hopefully they've been educated in these types of methodologies that we're talking about here from private banking. They would be able to see how advantageous this is, that they want to continue to put more money into it over time and continue to impact their life throughout their entirety of their life. So let's look at here, age 40 down here at the bottom. This is when the client would be age 40. So by this point in time, they're probably married, probably have a house, they're into their career most likely. They might have children. So at this point in time, is another kind of key area where they're kind of in their beginning of the stage of their life. And at this point, there's $72,000 of cash value and $343,000 worth of death benefit. And the last one we're going to point out here is at age 65, so potential retirement point. They would have just under $250,000 of cash value and $507,000 worth of death benefit at that time. So that's how the numbers shake out in a traditional whole life policy. And we're going to compare and contrast these in a simple, easy to read chart here at the very end. I'm just going to point these out in the illustrations. Now, this is the best performing private banking policy we could do on this individual. This is the illustration for that. We're going to look at the same columns, the premium contract, the cash value on the guaranteed side, cash value on the non-guaranteed side, which again is just the dividends rolled into that, and then the death benefit. So at year one, same scenario. There's more money going in from the existing whole life policy. There's more money available in year one. There's about $700 or $800 more available in year one. There's $3,500. The death benefit is lower by, I think, around $55,000 in year one, but that's good because there's more money can be put to work And death benefit is least of our concerns at this point, because statistically, we're not going to need that. It would come later in life. That's when we want the death benefit to grow. So let's jump down here to age 18, like we pointed out in the other one. At this point, we're up about $3,000. There's $19,000 here. In the other traditional whole life, there's about $16,000. So we're ahead of the game here by about $3,000. There's about $233,000 of death benefit at this point, which is still lagging a little bit behind the traditional whole life. But what I want to point out to you, though, here, and I can point this out in the previous illustration on the whole life, is at this point, there's $19,000, going into this or available in this, compared to paid 12 years into it, plus the original 4,200 that went in year one. So we've got about $18,500. Well, in this particular instance, we're ahead at this point in time of what we've put into it versus the cash that we can utilize. So at this point, we're putting the money to work better here because we're getting more return on that money early on, which is better for the children or grandchildren. They can put more money to work for them in their life. So that's super powerful. And here, age 21, let's jump to age 40. We're at 83,000 of cash value, 374,000 of death benefit. And then by age 60, we're at 280,000 of cash value and 565 of death benefit. So let's bring up the chart and show you, because I know that's a lot of numbers and it may kind of get scrambled in your head. So let's make it super simple, super easy. This column here is just the ages that we pointed out that had all those red boxes around them. The green text here is the cash value, and the black outline is the traditional whole life, and the yellow is a private banking. Then here in the blue text is the death benefit comparison. Again, the black outline of the boxes is the death benefit of the whole life, and then the yellow is the death benefit for the private banking. Now, I bolded and italicized the numbers that are superior when compared in each category of cash value and of death benefit. And like I mentioned, the cash value in our private banking type policy, the way that we design them with more cash value available up front, you actually have more cash value available from year one. There's $600 more available in year one. By the time we get to age 18, there's almost $3,000 more available. And that could be the difference between, buying books in college or, a little bit better car at that point, because who knows what inflation will be and what, car prices will be by then. That might be a beater car for 19,000, if hyperinflation continues. So that's very significant. By the time we get to age 40, where they're, they are probably well into the career, like I mentioned, they may have kids. We're talking about $11,000 more cash value. So when you're thinking about putting money to work and you start thinking about, what could that money do for them over their, up to this point, age 40, they've got $11,000 more to do something with in their life, to take loans against that and put that into their life to recapture principal and interest if they're still utilizing the banking concepts that we teach here. That's super powerful. And then by the time they get to retirement age, they've got about $50,000 more, $51,000 more that they can do. Now, when you think about retirement, you're talking about a tax-free environment with those funds, and you're talking about an extra, $30,000, not $50,000, $30,000 worth of cash value. That's significant. It's tax-free. So when you're talking about what are taxes going to be when this client is at age 65, taxes could be quite a bit higher by then. So having an additional $30,000 of tax-free money that they can have access to, whether they would actually do withdraw it at that time or they're still taking policy loans, it doesn't really matter at that point. It's all tax-free. And that can really help with their standard of living, help achieve their goals and dreams, maybe give more to charity. It could be a wide variety of things that they're able to do with more money because you're putting that money to work the most advantageous way. So let's look at death benefit. In year one, the traditional whole life has more death benefit, but like I said, that's not as significant as it is later in life. So the way we structure them, there's less death benefit going on in the beginning. And then by the time we get down here to age 21, we're almost breaking even between the two different types of whole life versus our private banking. But then as they get older in life, by age 40 here, there's, what would that be? $31,000, $31,500 more death benefit. So if something happened at age 40, and hopefully that doesn't happen, obviously, but the older we get, the more statistically likely we are to have something happen where we pass away. There's more money available then, which is more when you need it, because at age 40, if they have children, they're in their career, and maybe those children are not adults yet by the time this client's age 40, that money is going to go to that family to help cover the income and the needs of that family. And that's where it's more important. Then by age 65, we're talking about $58,000 more of death benefit that you're able to get as you get older. Now, if we continue this illustration onto their 60s, 70s, 80s, there'd obviously be a widening gap between how much better our banking policies are performing over a traditional whole life policy. And that is more and more important. The closer you get to needing the death benefit, there's more of it available to you. And that does some powerful things. So we talk about, just kind of recap some of these key advantages here, the comparison between a traditional whole life and our banking policy. There's more cash value to use up front, in the middle, at the end, all the way through, there's more cash value to utilize. Which means if you're utilizing that cash value to its maximum potential, meaning you're doing the banking process where you're taking a loan against the cash value, you're using that money for whatever you're going to purchase with that. Maybe it's school books, maybe it's college, maybe it's that first car or a mortgage or a business or whatever that is. You're able to loan more, which means you're able to recapture more by paying yourself back whatever that payment would normally be if you were making that payment to an outside financial institution or a credit card company or a lending institution. You're making those payments back on your line of credit against your own money. You're keeping that money flowing in your life, in your business. There's more of it that you can recapture, which just means you're accelerating wealth that much faster. And that is super powerful. Now, when you are able to utilize a private banking program, you're able to grow the money while you're utilizing it. I mentioned that there's the whole direct recognition versus non-direct recognition. Some companies are gonna, if you have $100,000 amount of money that you can borrow, they're gonna deduct whatever you're loaning or withdrawing from that. Ours are not like that. So that's very, very powerful. And again, the death benefit's there when you need it most statistically. And what I like to think about is just what you're doing is wonderful when you think about helping your kids and grandchildren get started. But as you fast forward all the way through their life, however long they're going to be blessed to be here, they're going to have children and grandchildren. They're going to have things that are a passion of theirs and their individual purpose in their world and how they're fulfilling that. And the more money that they can put into their family, into their passion and their purpose, whether it's a business, whether it's charities or their church, you're helping set up a cascade effect that's going to benefit more people in a greater way by doing this. So it's a very powerful thing that you're doing. It's a wonderful thing that you're doing. So I compliment you on doing that. And hopefully this video does give you some good understandings of why we would recommend doing the private banking program over just a straight traditional whole life, because it's going to do more for the children and grandchildren at the times in life when they need it more. Up front in the beginning, when they're younger, they're going to want more cash to work with. And then later on, there's that death benefit that's going to transfer tax-free to their heirs, their children and grandchildren, which would be what, your great-grandchildren potentially, depending on, grandchildren or great-grandchildren. And then any charities that they have or what they want to do with that money is going to be, doing wonderful things in the world. So it's very cool. And just lastly, if you have anything that you want to know further on this, don't hesitate to reach out, comment with this video, reach out to us at our agency, and we'd be happy to, go over anything that you don't understand or have further questions on. So hopefully this gives you a good idea of how to best utilize a life insurance policy to the maximum benefit of your heirs. So thanks for joining us, and we'll talk to you guys real soon in another video. Take care. Bye-bye.